Hello and welcome back to my channel. I'm Christy Vann with VANNtastic Finances, and on this channel I teach velocity banking. So I'm always getting the question, what is a line of credit? We are constantly looking for lines of credit because before we can set up your strategy, you have to have a line of credit, okay? So when we talk about lines of credit, what exactly are we talking about? A line of credit is flexible. It means that you have access to those funds. Once you go into a bank and you tell them you want to apply for a line of credit, they will do an application. Your credit score probably needs to be about a 650, maybe even a 670 to get into a good line of credit. Upon approval, they'll tell you what your limit is. Now, you don't walk out of the bank with a check. That's a loan. We don't want loans. They are going to approve you for a line. So you're not actually going to take any money out of the bank with you there unless you need the money and you will make a withdrawal while you are there. So the funds are flexible, meaning that if you don't want to use any money this week, you don't have to pull anything. And guess what? You don't pay on any balances that you haven't pulled. A loan, they're going to hand you a check or put the money into your account, and from that day, the interest starts accruing and you get a monthly payment. That is not the way it is with a line. With a line, you have access when you need it. So if you need $500 this week to pay towards a credit card, then you would transfer that amount into your checking account online or go to the bank if you must, pull the $500, and from that day, the interest would start accruing. Now, it will only accrue on the $500 that you actually took. It's not going to be on, say, a $10,000 line that you were approved for, okay? The banks figure interest for lines of credit on the average daily balance. So if you go 15 days and haven't pulled any money, but on the 15th day you pull $500, then as long as that $500 is out of the account, you're going to be charged on an average daily balance. So the 0 plus the 500 divided by 2 would give you kind of an idea of how much interest you would be charged. The interest rates are a little higher on lines of credit, but we're okay with that because the way we do velocity banking, you pay very little interest. So we're not worried about the interest charges on lines of credit. If you do velocity banking correctly, interest is not going to be your problem. So it does have a variable interest rate, meaning that just like we've experienced in the US, interest rates climb, so do the interest rates on the lines of credit. Again, I'm not worried about the interest rates. I'm worried about how you are using that account. Lines of credit are unsecured, meaning like with a loan where you would get a loan on a car, that would be secured. If you get a loan on a home, that would be secured. Maybe you've got a furniture loan, that would be secured. But with a line of credit, it is unsecured. It is revolving, meaning you can put money in as necessary and you can pull money out as necessary. If I need $500 today, I would go pull it out. If I want to pay that $500 back tomorrow, I'd go put it back in. So it's revolving in and out. That's the way a line of credit should be used, the way velocity banking teaches you to use it. Money in, money out. It's constantly revolving. You can use the funds for whatever you want. So whenever you need money, if you're going to put it on another loan to pay off that loan, if you're going to buy a car, if you're going to pay down your mortgage, if you're going to buy a TV, whatever you need the money for, you have access to it, and there's no questions asked about what you are using the money for. That is the danger. The danger is that you're going to use it frivolously. So you've got to adult up, decide you're not going to do a bunch of crazy spending. You don't need that new TV. You just want that new TV. That's the difference. We use lines of credit to pay off debt, things that's going to invest in ourselves. That's how we should use the lines of credit. That's what builds wealth. They will give you a minimum monthly payment on the line depending on what the amount is that you have used during that month. You can make a minimum monthly payment, but I don't suggest it. We use our income into lines of credit. Our income goes in, keeping that balance down, keeping our interest charges down. You can pay a minimum monthly, or you can chunk that line of credit down just like we teach you to do in velocity banking. And of course, if there's a zero balance, you don't have a payment due on that account. That is what's so beautiful about the line of credit. The line of credit can be used or not. It depends on what you need. When you're paying off debt, it's a beautiful resource, because if you have a 30% credit card and you have a 12% line of credit, of course you would pay that off. But where it's even more beautiful is when you have loans that they say is a little bitty interest rate, 2.5% or 4.99%. It depends on how you use that line, but you can almost always beat that percent rate on a loan. And people will argue with you, oh, you don't want to get a high line of credit. That's so stupid. Somebody was saying that it's scandalous to use a higher interest rate when you could go get a little baby interest rate on a loan. Those baby interest rates on loans end up costing you a lot of money, and you don't even realize it because they've got it so set up, and we're so brainwashed to make those payments that we're not even thinking about the interest that they're really charging. If you have a 7% loan and you use a 12% line of credit to pay it off, you're going to win with that line of credit if you use that line correctly. So there are a few different types of lines of credit. You have HELOCs. A HELOC is a home equity line of credit. You have to own a home, and your home has to have equity before you can get a HELOC. You can get a BLOC, a business line of credit. You have to have a business, of course, so that you can get the BLOC. They usually have higher limits than a regular PLOC, which is a personal line of credit. A PLOC will sometimes be used even for overdraft protection. So if you have a line of credit at your bank, it has a credit card, you may think it's just a credit card that you have, but it may actually be a PLOC that can be set up as overdraft protection. No fees are associated with these lines of credit. So you can really be a winner if you have a credit card, a PLOC, and overdraft protection all in one. It's a beautiful resource, and you may have it and you're not aware. So you will want to check with your bank. If you have a credit card with the same bank that you have a checking account, check that out and see if you can't take withdrawals from that credit card into your checking account to use it as you deem necessary. Remember, the danger is using it frivolously. We don't want to use our lines of credit in a childish way. We are using lines of credit to get out of debt, not to get into debt. And I know people say you're getting into more debt to get out of debt. That's stupid. That is stupid. That's not what we're doing. We are getting lines of credit to get rid of debt that is wearing us out on that interest. So go out, find your line of credit that you need today, and get started with Velocity Banking, because I promise you, if you use Velocity the way it's meant to be used, you are going to be amazed at how fast your debt will pay off just using lines of credit in your cash flow. Thank you all for joining me today. If you have any questions or comments, please leave them below. I look forward to seeing you in the next video.